Okay, let's move on to just take a look before we before we go over other cases, how we would see these transactions being represented on balance sheet. So again, this is important for each and every chapter. When you know what are the new accounts, you have to ask yourself how would it be represented under financial statements. Because remember, eventually all of these will be posted, will be summarized, and then reported in financial statements. Okay, T accounts and journal entries is just the middle part, but that's not the information that eventually outsiders would see for the company. So they will be viewing financial statements. So if we take a look at earlier that example, if we issued 1 million shares, this example here, it tells you that we have issued already 2 million shares. Common stock account would always hold, again, just the par value times the number of shares. So you see there's 2 million there's, but the part that's above face value, we consider it as another account paid in capital in excess of par. So you see 19 million, earlier the transactions that we just did, 19 million is listed in the second account. They're both part of equity. The purpose here, we're just trying to understand whether we have been issuing this stock at the face value or above it. If it's above it, we have a separate account to hold it. Okay, but the idea is the same, it's part of equity. So if we add them up, the total equity right now is $21 million. That's the part that we externally generated from the public. Not based on selling items, not based on providing sales services of any kind, but based on issuing stock. Okay, so $21 million. At the same time, the cash account under, if we look at asset section, cash account, you also have additional $21 million. Now, retained earnings is the second part to equity. It's the internally generated part. That's the part based upon if the company is a service type of business, then that's based on service revenue. If the company is a sales type of business, that's based on sales revenue. Later on, we close it to retained earnings account. Okay, so this $9 million is the part based on providing certain type of goods, providing certain type of service. But the upper part, $21 million, is based on issuing stock, externally generated fund. So net worth of the business altogether, including two parts, is $30 million. You know, if we take a look at the common stock category, it tells you $1 par, that's the face value, and then after that it tells you 20 million shares authorized. Now the 20 million shares authorized is the number, the maximum number of shares that company is able to issue to the public. Okay, so that part will be given to you each and every problem. When a company incorporates, the state will grant them the number of shares that they are able to issue, the threshold of it. So that's 20 million shares. And it tells you right now that they've only issued about 1/10 of it, 2 million shares. Okay, so the dollar amount there, 2 million, is based on that 2 million shares. They still have 18 million shares that they could additionally issue to the public. Okay, so you have to understand the differences. Authorized doesn't mean that they've actually issued out. That's just the threshold that the maximum number of shares that they could issue to the public. The number of shares that they actually gave out is 2 million. So meaning that next year they can decide to issue additional 2 million shares. And then the following year they issue additional 2 million shares. Then we determine what is the market price then, figure out if there's premium based on this issuance. Okay, so total paid-in capital is the sum of common stock and paid-in capital in excess of par. That's the $21 million part. And the balance, how we get to this $2 million, is just the number of shares times face value. So always keep in mind, common stock, always just hold the face value times the number of shares.